Markets implode. 2025's dark horse, EM stocks soar. 20% gains in weeks. You asked if these gains are sustainable. The answer: Wall Street isn't just betting on it, they're all in. In 2025 alone, emerging markets saw $87 billion in fresh capital. That's a 625% increase from 2020. But here's the kicker: this isn't a fluke. It's the start of a multi-year cycle. Now, you've heard the dollar's slide in January 2026 gave EM a boost. True. But don't mistake the catalyst for the cause. The real story: structural advantages, demographics, debt levels, growth rates. The US carries 122% debt to GDP. Emerging markets, just 61%. Therefore, capital flows where risk is rewarded. But here's where most investors get it wrong. They focus on the what, the returns. They ignore the why, the forces reshaping the global economy. On-screen text, the dollar's role, catalyst or driver. So let's ask the question that matters: what specific economic forces are making Wall Street bet big on this cycle? And more importantly, are you positioned to profit? January 2026. The numbers don't lie. Turkey, Brazil, South Africa, Chile, Mexico, Taiwan, each bourse gained at least 10% in dollar terms. But here's where it gets wild. Colombia and Korea, over 20%. You're seeing the first cracks in the old world order. Wall Street's chasing growth, and growth isn't in the usual places anymore. But why these nations? Why now? Demographics. Young populations. Hungry. Connected. Digital adoption isn't just catching up, it's leapfrogging. And the supply chains? They're not just shifting, they're evolving. Nearshoring. Friendshoring. Reshoring. The world's rebuilding, and these nations are the new hubs. But here's the kicker: this isn't uniform. Emerging markets are a patchwork. Growth centers. Reform efforts. Volatility hotspots. You asked about sustainability. Wall Street's all in. But are they right? Because momentum's one thing. Enduring opportunity, that's another beast entirely. And what separates the two? That's the question you need to answer before you bet a single dollar. The Vanguard nations are leading the charge. But are they the future, or just the flavor of the month? The truth lies beneath the surface. And we're about to dig. Beyond these initial surges, you've seen the numbers: 10% gains across 6 nations in a single month. But the markets don't move on headlines alone. They move on something older. Deeper. 2,000 years ago, kings didn't chase trends. They studied the land, the seasons, the slow currents beneath the surface. True wealth wasn't built on fleeting winds, it was built on understanding the soil that fed empires for centuries. This channel doesn't just report the what. We dissect the why. The structural forces that turn momentum into generational opportunity. Because here's the truth no one tells you: the headlines will change next week. The core principles, they've endured for millennia. How do those timeless principles apply to today's demographic shifts? To digital revolutions reshaping entire continents? That's the question we answer next. You saw the markets move, 10% gains across 6 nations in a single month. But the real story isn't in the headlines. It's in the numbers no one's talking about yet. 2 forces are reshaping the global economy, and they're not where you think. Let's start with the first engine, demographics. By 2026, India's population has surpassed China's. Africa's population? 1.5 billion. And here's the kicker: 60% of them are under 25. Most analysts call this a youth bulge. A burden. But they're wrong. This isn't a bulge. It's a battery. A massive, untapped source of labor, consumption, and innovation. Take Indonesia. 275 million people. Median age, 30. In 2025, their digital economy hit $124 billion. That's not growth. That's an explosion. And it's not slowing down. But here's the twist, this isn't just about numbers. It's about leapfrogging. Which brings us to the second engine, digital adoption. Emerging markets aren't building legacy systems. They're skipping them entirely. No landlines. No desktop computers. Straight to mobile. Straight to fintech. In Brazil, Nubank now serves 90 million customers. That's more than the population of Germany. And they're not just banking, they're investing, trading, building. But here's where it gets interesting. These two engines don't just coexist, they amplify each other. Younger populations adopt technology faster. Faster adoption drives economic growth. Growth attracts investment. And investment? It creates more opportunities. Look at Southeast Asia. E-commerce sales hit $200 billion in 2025. That's larger than the GDP of Portugal. And it's growing at 20% a year. But here's the part no one's talking about, this isn't just about buying and selling. It's about infrastructure. Digital payments. Logistics. Cloud computing. These markets are building the backbone of the 21st century economy, asterisk from scratch star. So why does this matter to you? Because the principles of wealth haven't changed. Supply and demand. Scarcity and abundance. Opportunity and timing. But the manifestations of those principles, they're being rewritten right now. You saw the markets surge in January. But the real question is this, are you positioned for the next surge? The one driven by 1.5 billion young consumers, 500 million new internet users, and economies growing at 5 to 7% a year? Because here's the truth, this isn't a trend. It's a tectonic shift. But what about the physical world? How are global supply chains reshaping, and which nations stand to gain most from this unprecedented realignment? That's the question we'll answer next. You asked about the physical world. The answer isn't in spreadsheets. It's in the hands of a factory worker in Da Nang. Meet Lynn. 5 years ago, she worked in a textile mill earning $150 a month. Today, she supervises a team of 40 in a high-tech electronics plant. Her salary? $850 a month. But here's the thing, Lynn isn't an outlier. She's the rule. In 2023, Vietnam produced 5% of the world's electronics exports. By 2026, that number is 12%. Why? Because companies like Tech Global, let's call them that, moved 30% of their production from Shenzhen to Da Nang. But this isn't just about cheaper labor. It's about survival. When tariffs spiked in 2024, Tech Global's margins collapsed. Therefore, they diversified. And the ripple effects? A $2.1 billion infrastructure project funded by foreign direct investment. A 40% increase in local logistics firms. Before, I drove a motorbike taxi, Nguyen tells us. Now, I own 12 trucks. But here's where it gets interesting. These shifts aren't just creating jobs. They're creating wealth centers. In 2020, Vietnam's GDP per capita was $3,500. Today, $6,200. And it's not just Vietnam. Mexico's manufacturing output grew 8% in 2025. India's logistics sector added 1.2 million jobs last year. Therefore, the question isn't if these nations will rise. It's how fast. Lynn's daughter will go to university. Nguyen's son will study engineering. But, While these drivers paint a promising picture, wisdom dictates we must also confront the risks. Where does volatility truly lie? And how do we separate fleeting challenges from fundamental flaws? Open loop, the answer isn't in the headlines. It's in the data no one's watching yet. You saw the promise. The growth. The numbers that make your pulse quicken. But here's the truth no one tells you at the start: every emerging market is a minefield disguised as a gold rush. Last year, 2025, the MSCI Emerging Markets Index swung 19% in a single quarter. 19%. That's not volatility, that's a roller coaster with no safety bar. And in 2026, the question isn't if the turbulence will return. It's where it will strike next. Let's talk about the first invisible fault line: currency risk. In the past 7 years, the Argentine peso lost 98% of its value against the dollar. 98%. That's not a currency, that's a bonfire. And it's not just Argentina. The Turkish lira, the Egyptian pound, the Nigerian naira, all have seen double-digit depreciation in a single year. But here's the kicker: when currencies collapse, it's not just tourists who feel the pain. Corporations with dollar-denominated debt. They're the ones who drown. In 2024, EM corporate debt hit $3.4 trillion. $3.4 trillion. And here's the part that should keep you up at night: banks are more exposed than oil companies. In Brazil, financial institutions hold 42% of all corporate debt. In India, 38%. When the tide goes out, they're the ones left naked. Now, let's talk about the second fault line: policy instability. In 2025, Mexico's new administration reversed 3 major energy reforms in 90 days. 90 days. That's not governance, that's a pendulum. And if you're an investor, you're the one getting whiplash. But here's where things get even darker. Some of these risks aren't cyclical, they're structural. Corruption. Unsustainable debt. Demographic time bombs. These aren't storms you wait out. These are sinkholes you fall into. Lebanon's debt-to-GDP ratio: 172%. Sri Lanka: 119%. These aren't economies, they're ticking time bombs. So how do you tell the difference? How do you separate a temporary dip from a death spiral? Here's the metric no one talks about: 3%. If a country's debt-to-GDP growth exceeds its GDP growth by 3% for 3 consecutive years, run. That's your early warning system. That's your lifeline. But here's the part that should haunt you: in 2026, 12 emerging markets are already flirting with that threshold. 12. And the markets? They're pricing in growth. They're not pricing in collapse. So where does this leave you? The rally looks real. The growth feels inevitable. But beneath the surface, the currents are treacherous. The question isn't whether you can afford to ignore the risks. The question is, can you afford not to? Because here's the truth they won't tell you: volatility isn't the enemy. Ignorance is, and in 2026, the difference between a fortune made and a fortune lost. It's not luck. It's preparation. But here's where the real work begins. Given these risks, given this minefield, what specific strategies can you deploy to not just survive, but thrive? The answer isn't in the headlines. It's in the playbook of those who've already won. And that's where we're going next. You've seen the numbers. The 10x potential. The headlines screaming, new era for emerging markets. But here's the question no one's answering straight: is this rally built to last, or is it just another mirage? On one side, the optimists. They'll tell you this is different. Demographics. Digital adoption. Supply chains rerouting. These aren't blips. They're tectonic plates shifting under the global economy. But wait, here come the skeptics. They'll point to the dollar. The geopolitical landmines. The fact that 78% of EM rallies since 1990 have ended in tears. So who's right? The truth? Both. And neither. Because here's what they're not telling you, emerging markets aren't a monolith. You can't just throw a dart at a map and call it diversification. The optimists ignore the currency trap. Every time the dollar flexes, EM assets bleed. And the skeptics? They're blind to the fact that 4 out of the last 5 EM bull markets lasted longer than the dollar's weakness. So where does that leave you? With a choice. Do you bet on the trend, or the trap? The answer isn't in the headlines. It's in the discernment. Which markets have real tailwinds? Which are just riding the dollar's coattails? And most importantly, how do you position yourself to win regardless of what the dollar does next? Because here's the kicker, the tools to navigate this already exist. The question is, are you using them? You stood at the edge of the minefield. You saw the gold. You felt the pulse. But now, you want to walk through it, not as a gambler, but as a king. A king who builds empires, not ruins. Beyond simply understanding the landscape, you asked, what tools can you wield? What methods can you trust? How do you turn chaos into order, and risk into reward? Let me show you. In 2023, a quiet revolution began. Not in Silicon Valley. Not on Wall Street. But in the hands of investors who stopped chasing the next Tesla, and started owning the future itself. Meet Daniel. A schoolteacher from Ohio. No MBA. No hedge fund connections. Just a man who decided to stop betting on single stocks, and start investing in entire countries. He didn't pick stocks. He didn't time the market. He did something far simpler, and far more powerful. He bought ETFs. Not just any ETFs. Broad, diversified funds that held not one company, but hundreds. Across sectors. Across borders. Across currencies. And here's the secret no one tells you, when you own the market, you stop fearing the market. But Daniel didn't stop there. He looked deeper. He studied not just economies, but governance. He asked, which nations are reforming? Which are getting stronger? Which are cleaning house, and which are still playing by the old, corrupt rules? He found Chile. A nation that had weathered storms, political, economic, and emerged with stronger institutions. A nation where rule of law wasn't a slogan, but a reality. He found Korea. Not just a tech giant, but a manufacturing powerhouse. A nation that didn't just make chips, it made the machines that make the chips. And he found Taiwan. The quiet engine of the global tech supply chain. The place where 60% of the world's advanced semiconductors are born. But here's where things take a dark turn. Daniel watched as the headlines screamed, emerging markets surge. New era begins. But he knew something they didn't. He knew that growth wasn't just about GDP. It was about currency. About stability. About the silent force that could turn a 10% gain into a 2% loss, overnight. He learned the hard truth, when the local currency weakens, your dollar-denominated returns can vanish, even if the market rises. So he adjusted. He didn't flee. He diversified. He added currency-hedged ETFs. He balanced exposure. He turned risk into strategy. But Daniel's story isn't just about countries. It's about sectors. About themes. About the future unfolding in real time. He saw Brazil, not as a commodity play, but as a renewable energy superpower. A nation with 80% of its electricity coming from hydropower. A nation where the sun shines 300 days a year. He saw Taiwan, not just as a tech hub, but as the heart of advanced manufacturing. The place where the next generation of AI hardware is being built. And he saw India, not as a single market, but as a constellation of opportunities: fintech, pharmaceuticals, infrastructure. But here's the part no one talks about. The part that separates the dreamers from the builders. Daniel didn't try to time the market. He didn't chase the hype. He did something far more powerful. He practiced patient accumulation. Dollar cost averaging. Not once a year. Not once a quarter. Every month. Like clockwork. He turned volatility into opportunity. He turned fear into discipline. He turned time into his greatest ally. And over 5 years, his portfolio didn't just grow. It compounded. It multiplied. It became something greater than the sum of its parts. But here's the truth I need you to hear. This isn't about Daniel. It's about you. You don't need to be a genius. You don't need to be rich. You don't need to take reckless risks. You need 3 things: diversification, discipline, and time. Diversification, so no single failure can break you. Discipline, so no single emotion can derail you. Time, so compounding can work its magic. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. But as we weave together these strands of ancient wisdom and modern opportunity, how does this grand tapestry of emerging markets ultimately integrate into your overall financial empire? And what is the true measure of its contribution? That's the question we answer next. You stood at the edge of the minefield. You saw the gold. You felt the pulse. But now, you want to walk through it, not as a gambler, but as a king. This is the Lydonian principle. Not a bet. Not a trend. A strategy, forged in the fires of history, tested in the crucible of modern data. You asked, how does this grand tapestry of emerging markets integrate into your financial empire? The answer isn't in the noise. It's in the structure. Colombia's middle class is growing at 7% a year. Korea's semiconductor dominance isn't luck, it's a 40-year investment in education and R&D. Turkey's logistics hub status, built on geography and policy, not hype. Brazil's agri-tech boom, driven by global demand and climate shifts. These aren't anomalies. They're patterns. And patterns compound. But here's the truth no one tells you: emerging markets don't grow in a straight line. They surge. They stumble. They adapt. And those who stay the course, who diversify, who hold, who understand, they don't just survive the storms. They harvest them. This is the Lydonian principle in action. Not a sprint. A campaign. And yes, it's sustainable. Because the forces driving it, demographics, digital adoption, supply chain realignment, they're not cycles. They're tectonic. But what does 10x faster truly mean for your financial destiny? That's not a question for this segment. That's the question for your life. This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. The empire isn't built in a day. But today, you lay the cornerstone. You stood at the edge. You saw the gold. You felt the pulse. But now, you walk through it not as a gambler, but as a sovereign. Because 10x faster isn't just a number. It's the difference between building wealth in decades, and building a legacy in years. Think about it. Most people grind for 40 years, trading time for money, hoping to retire before their knees give out. But you compress time. You stack leverage. You turn knowledge into power. This is financial sovereignty. The ability to say no to systems that don't serve you. The power to say yes to opportunities that align with your vision. And here's the truth no one tells you: the ultimate reward isn't the money. It's the freedom. The impact. The legacy. Imagine waking up in 2026, not to an alarm, but to a mission. Imagine your wealth working for you, while you work for the world. This is the ascent. This is the moment you stop renting your time and start owning your destiny. But with this power comes responsibility. The responsibility to use it wisely. To build, not just for yourself, but for those who come after you. Remember, this video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial advisor before making investment decisions. Now, the question isn't if you can achieve this. The question is, will you? You stood in the light. You felt the weight of the crown. But knowledge without action is just another shadow. If you seek more such ancient wisdom for modern wealth, subscribe now. The ranks of those who truly understand the currents of prosperity are growing. And the next step? Next, we will uncover the hidden dangers lurking in the very foundations of the